Markets are increasingly confident the US Federal Reserve will deliver a third consecutive 0.25% interest rate cut on the 10th of December. But Fed officials, they are divided over whether inflation or the labor market is the bigger issue, suggesting a split vote. That also reflects a slower pace of rate cuts in 2026. In this next report, we decode those expectations and more.
After the last Fed meeting, policymakers appeared less reluctant to cut rates again this year. In recent weeks, Fed officials have acknowledged that even after 1.5% of cumulative rate cuts, monetary policy remains modestly restrictive. However, on the risks of the Fed's dual mandate of price stability and maximum employment, policymakers seem more divided. Expectations have swung wildly in the build-up to the December 10th meeting, but a weaker jobs growth story has turned bets in favor of a third rate cut in a row. Still, several Fed members remain concerned that the potential for stickier, more elevated inflation from tariffs cannot be ignored. For these policymakers, the economy is still growing. Stock markets are at all-time highs and unemployment remains very low. So to them, there doesn't appear to be a pressing need to cut rates again. Still, market bets show the December rate cut is more or less a done deal. For investors, what the Fed says about the 2026 rate path is more important. The riskiest corners of the markets, like cryptos, have taken a beating. For the first time in over a decade, cryptos will diverge from stocks if the current trend continues through to the end of the year. While the Fed is expected to project one more rate cut, private jobs data points to more easing action. However, will inflation play spoilsport is an important question to look at. Trump's tariffs are slowly creeping into everyday goods prices. Will that expand to other goods and add to inflation pressures? That is the delicate balance the Fed has to look at. But with the current Fed boss Jerome Powell's term ending in March, bets are for Trump's new hire to adhere to the president's desire for deeper and faster rate cuts. Will the new Fed chief be in a position to do so? Will the data support more rate cuts? That uncertainty remains. With the Fed's favorite inflation gauge currently at around 3% annually, for now, markets do not seem to be looking too far into 2026 and are only weighing in on Fed action under Powell. Business Bureau WION, World is One.